former president, carrying 4 or 5 indictments. It would be historic, and there's no historical measure to how that might impact the electorate.
And just from the same question from the Democratic side, is the Democratic Party united behind President Biden making another run here?
You know, as much as it's going to be, there's no clear alternative. And while some have asked if, you know, the president should drop out here and bring in a younger Democrat, no one exactly is raising their hand for that right now. So I think as long as he wants to do this, it's probably his. But if you look at the poll yesterday from Quinnipiac University, it found that nearly half, I believe it was 47% of voters from both parties would like to see somebody other than not only the names we're talking about, Paul, but they want to see a third party candidate. And that brings us to this whole idea of the no labels party. They held a big event in New Hampshire this week with Joe Manchin. And that's the one thing that upsets Democrats. When you ask them about a third party, they say that is the most surefire way to reelect Donald Trump. That is what would keep Joe Biden out of the White House.
All right, Joe. Great analysis, as always. Joe Matthew, he is host of Bloomberg Sound On and Bloomberg's Balance of Power on television, Sound On radio. So Joe Matthew is our multimedia Washington, D.C. source. And he and Anne Marie Hordern last evening spoke with presidential candidate Chris Christie, former governor of my home state, New Jersey. So lots to talk about there. It's going to be a fascinating run into the 2024 election.
It definitely is. And then him calling out how those classified documents case is the worst of the Trump charges at this point.
Yeah, that's going to be interesting to see how that plays. I will have, obviously, full coverage going forward. This is Bloomberg. All right, let's get some company news right now. Steve Rappaport.
Paul, American Airlines descends into red territory after a lackluster forecast for the third quarter. More from Bloomberg intelligence analyst George Ferguson.
I think that's because their guidance for the third quarter was lighter than both United and Delta, and was sub mid-single digit sort of operating margins, which is a bit surprising. I think we're trying to figure out whether or not they're sandbagging a little bit, or there's going to be more of an effect from the JetBlue NEA unwind, where, you know, American and JetBlue were working together in the Northeast.
That was Bloomberg intelligence analyst George Ferguson. Shares of American Airlines are down 5%. Netflix investors were discouraged by an outlook that fell short of estimates, but there's a silver lining in its earnings report. The streamer's crackdown on password sharing appears to be paying off. Bloomberg's Kimberly Adams has more.
Steve, the company says its crackdown on password sharing helped spur strong subscriber growth in the just finished quarter, signing nearly 6 million new subscribers. That topped forecast, but investors were disappointed by the company's sales forecast for the current quarter. Netflix is also getting rid of its $9.99 monthly ad-free plan.
Thanks, Kimberly. The new ad-free plan for members will cost $15.49 per month. Netflix stock down more than 8%. And we have some more bad news for Tesla. The EV maker is recalling nearly 16,000 of its Model S and Model X vehicles because some front row seatbelts may not have been properly connected after getting repaired. And those are the company stories we're following this hour. I'm Steve Rappaport. This is Bloomberg. Stay tuned for more Bloomberg Markets with Paul Sweeney coming up after this.
news, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom. This Bloomberg Business Flash. The NASDAQ 100, right now, it is down 1.3%. That is a 205-point decline, with Netflix set for the biggest intraday decline since December. That follows, of course, their disappointing revenue forecast. Tech is projected to have a second quarter earnings per share decline of about 3.5% overall, but analysts have started to revise estimates higher. So that could place some pressure on a sector with still some of the lofty valuations. Treasury yields rising to right around session highs on the front end, just about 11 basis points higher on the yields there, being led by the increase again in the front end in the wake of an unexpected drop in the weekly initial jobless claims. And then you had sales of previously owned homes dropping to a 5-month low for the month of June. We got that data this morning. This is not a question of demand. Supply is the issue there. Again, the S&P 500, 17 points lower. That is down 0.4%, 45.48 on the index. The Dow Jones Industrial Average up 236 points. That's a rise of 0.7%. We're at 35,297 on the index. And again, the NASDAQ 100, 212 points lower. A decline there of 1.3%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg. Did you notice Jess's, this is how fashion savvy she is. Her nail polish matches her top.
I didn't even think about that.
And what you're also going to learn is green
It is my
her
favorite
color.
color.
That's how we go.
Emerald is my birthstone, so
okay.
green
The
is
color
my
of
favorite
cash.
color. Exactly, and the color of money. I can't go wrong with that. Thank you, John Tucker. We appreciate it. I want to get straight to our next guest, David Kudla, founder and CEO, Chief Investment Strategist at Mainstay Capital Management, joining us on Zoom to discuss all things sectors and stocks that he likes in the stock market right now, and also as well as some of the latest economic data that has come out. I have to get your thoughts first, David, on the ongoing debate about where the economy is headed. Is a recession pending? If you look at the ECFC function in the Bloomberg terminal, clearly forecasters have pared back those expectations, and you don't see 2 consecutive quarters of a contraction here that you would have seen coming into this year. What's your take on where the economy's headed?
Yeah, Jess, I think that it's amazing. If you look at where we were 6 months ago, or even a few months ago, with the forecast of a recession versus a soft landing, it's almost a reversal. We've been in the camp that, there's a very good chance that the Fed could manage a soft landing, that we could avoid any kind of significant recession. We're seeing more and more people come into that camp. That scares us a little bit, but there are analysts out there that their base case now is for a soft landing. But there's a lot of economic data to back that up. Just start with GDP, 2% in the first quarter. Atlanta GDP now for the second quarter is at 2.4%. We're seeing a very resilient economy in the face of these Fed rate hikes. We've got consumer sentiment is up, housing is recovering, although a bit choppy. Jobless claims are down. It's just a lot of data that supports that we have a resilient economy, and we're going to continue to have that as the Fed finishes up their work.
David, one of the things people looking at the equity markets have been saying, about the first half performance in the, the 15% gain in the S&P 500, there's just no breadth in the market. It was, into a handful of stocks. We've started to see that breadth improve a little bit over the last several weeks. Is it time to maybe look at, small stocks, small cap stocks, mid cap stocks? Is that a way to maybe look for some opportunities?
Yeah, we think so. That's what we've been doing. We've enjoyed the Magnificent Seven and the run that they've had this year, and certainly tremendous leadership. And there's fundamental reasons why they've done so well. But they've come a long way, and we think it makes sense. We are seeing that very narrow leadership start to broaden. We're seeing breadth widen out. Look at small caps. The Russell 2000 over the past month is up 6% versus the S&P 500, 3.7%. The mid-cap S&P mid-cap 400 up 5.7%. So we're seeing almost a doubling over the past month of the S&P 500 index by small caps and mid caps. So we think there's opportunity there. Also some opportunity to start looking back into value. If this this forecast for the economy is better than expected, then we can feel a little bit better about value and cyclicals.
When it comes to looking at where Wall Street strategists were expecting the S&P 500 to end the year, coming into 2023, they were thinking around 4,000, which really would have been unchanged from where the S&P 500 ended last year. But if you look at Lu Wang, one of the star reporters on our cross-asset team, she just put out her monthly table that looks at where the average target is for the S&P 500. Right now, it's at 4,200 when you're looking at a little around 24 of these top strategists on Wall Street. That's actually higher. It had been right below 4,100. So you see strategists like Jonathan Golub over at Credit Suisse that did raise his price target to 4,700 just this week. As from a money managing perspective, and when you're looking at strategists getting a bit more bullish on these calls, but still well below where the S&P 500 is trading here, what threshold do you need to see to where you think that maybe they're getting too excessive? Because clearly they're still behind, right, when you're looking at the sell side.
Yeah, and he took a big leap when he raised it to 4,700. He raised that 650 points. That's a big jump from his earlier forecast. But that's what we're seeing. We're seeing, just like we see in these buy and sell ratings with the analysts just trying to catch up to where the stock is. They're trying to catch up to where the index is moving, and we think that the index will be higher by the end of the year. We think that we'll see forecasts continue to rise because the environment has changed so much from where we were at the beginning of the year. Those analysts had their reasons to be more pessimistic, but what I just talked about, we've got a Fed that it should be one and done next week. They should already be done. You've heard me say that, but the Fed's going to be done, and I think the market's looking past that anyway at this point, looking at Fed cuts in 24. We're looking at certainly a 5 to 10% correction is in the cards here.